I'm Kate Mosley with Timewise. Here at Timewise, we want to help you create purposeful wealth for a more meaningful life. For more videos like this one, subscribe to our YouTube channel. Today, I want to talk about taxes. Yawn, right? Look, we can't escape them. They affect everything that we spend and invest, and I know that there are a bunch of you out there that are having heart palpitations, wondering about future tax increases. So let's talk about that for a second. First, we need to remember that a campaign promise is not an automatic fact. Running for office is like a really big job interview, and they're trying to get hired. And candidates make proposals of what they do if they got hired. Elected officials with even the best of intentions sometimes have a really hard time turning those proposals into a reality. So let's start with what we do know as of right now, April 2021. The current administration's tax proposal could affect individuals in the following ways. First, increasing the federal income tax for top earners by another 2.6% and reducing the top tier tax bracket from $523,600 down to $400,000. Capital gains. Now, right now, under current law, long-term capital gains are taxed very favorably with respect to wages, and an individual earning $0 to $40,000 pays no capital gains tax at all. An individual earning between $40,000 and $441,000 pays 15% capital gains, and an individual earning more than that pays 20% long-term capital gains. The Biden administration's proposal is taxing capital gains as ordinary income for those who make $1 million or more annually. While subject to change, as of right now, the proposal showed that there is no increase to capital gains rate for taxpayers with an income below $1 million. Another way it may change is 401k retirement savings plans. If the plan were to become law, the tax deduction for contributing to a 401k would be replaced by a possible tax credit. And this change would likely result in high income earners getting less of a tax break on their 401k savings, but low and middle income earners getting a bigger tax benefit. Now, as for changes to Social Security benefits, certain recipients would see their benefits increase under the Biden plan. For example, people who have received benefits for more than 20 years would get a 5% bump, while widows and widowers would receive up to a 20% bump to their benefit. In addition, the annual Social Security cost of living adjustment would no longer be measured by the standard CPI index, as it is now, but instead it would be measured by the CPIE index, a consumer price index for the elderly. The index is designed to specifically track inflationary changes that are faced by retirees, which are often much greater than those of younger Americans for many different reasons, including the need for more health care. President Biden's plan also calls for lowering the eligibility for Medicare from 65 to 60, in part to benefit older workers who may have lost their job because of the current pandemic. So with all that being said, we like to prepare for the what ifs, don't we? So contributing to 401ks, IRAs, and even some types of investment-only annuities will be effective strategies to limit that overall tax exposure, even if tax rates do increase in the future. And why is that? It's because almost all households will have lower income when in retirement. Your wages in your earning years will be higher than the retirement income you'll receive from Social Security pensions and other payments. Buy and hold is another effective way to reduce tax exposure, no matter what happens to tax rates. Remember that long-term gains are taxed at a lower rate than short-term gains, but more importantly, a retiree doesn't have to worry about salary or wages, forcing those long-term gains to be taxed at a higher rate. As more information rises, we will keep everyone informed. Long-term investors can sit tight for right now, but if you have a high appreciating asset that you want to talk to us about, please give us our office a call.